Sector rotation strategies were very popular in the 90s. Many hedge funds and billions of dollars are still invested in this strategy in some flavor or another. In this video, I will show you how simple it is to implement such a strategy in today's market, and you will be able to beat the stock index. First of all, let's start with the definition. The stock market is divided into 11 sectors. This classification is done by the GICS. This is the Global Industry Classification Standard. Those 11 sectors are subdivided into 24 industry groups, 69 industries, and 158 sub-industries. And these are the 11 sectors. We have the healthcare, materials, real estate, consumer staples, consumer services, financials, and technology. Now, for example, the health sector includes pharmaceuticals, medical devices, healthcare, biotech stocks, insurance companies, while consumer discretionary include retail, e-commerce, hotel, luxury goods, and leisure and travel industry. Basically, all the public companies that are listed on the stock exchange are categorized into an industry and then into a sector. So instead of holding individual stocks, you can hold a sector that holds many stocks inside it, and therefore you are diversifying into that sector. In today's market, we are fortunate because we have many types of ETFs representing those sectors. We can invest in one ETF that buys all the stocks in the sector or in subdivision of this sector. For example, here we have the US sectors represented by SPDR's ETF. So each ETF represents one sector, and you can see here we have 11. Also, we have the US small cap sectors represented by ETFs, and we have the global sectors. Now, these are the major ETFs representing those sectors. But of course, you can have subsectors, industries, sub-industries, and so on and so forth. Also, for each sector, you don't have a single ETF. So, for example, these are the ETFs representing the 11 sectors issued by the SPDRs. But also we have the same sectors represented by different ETFs from Vanguard. The reason is because the US is very liquid and easily we can have competition representing those sectors targeting your money. Also, I want to bring your attention that even though we have the same sectors, they don't actually work in the same way. And here I brought two examples. So this is Vanguard, the energy index. And we can see we have 99.72 represented by the energy sector and 0.18% represented by basic materials, 0.1% in utilities. Same sector represented by the SPDRs has 100% in energy. Here is, for example, the top 10 holding for the Vanguard energy sector. And we can see ExxonMobil is 22.8%, Chevron is 14.8%, ConocoPhillips 7.3%. And if we look at the top holdings in the SPDRs energy sector, we can see Exxon is 23, Chevron is 18, and ConocoPhillips is 4.46. So the difference is big. That's why the same rotation strategy implemented on the US sectors using the SPDR ETF will behave differently, will produce different results than if you invested using the Vanguard ETFs, because each ETF has a different algorithm to pick the allocation for each stock in that sector. Now, that is not a glitch because depending on the manager running that ETF, they can have a different algorithm. And I can show you here, for example, how easy it is. For example, this is the technology services. And we can see that Microsoft is the big cap in this sector. So I can choose my ETF to represent the same weights, or to represent equal weights, or to represent price per earning, and so on and so forth. So there are a million ways to represent each sector. For our purposes, we will stick with Vanguard and SPDR ETFs. These are the most liquid ETFs you can get in and out with minimal slippage and sometimes zero slippage. Now let's build our rotational strategy. So we have 11 sectors. Every month, we will look at the best performing sectors and we will invest in those sectors. That means we will not put our money in all sectors equally. We will pick the top 5 sectors every month to invest in. And that's why it's called rotational, because every month you measure again and you rotate into the best performers and rotate out of the worst performers. And this strategy is based on the concept that all these sectors perform differently every month. And we can check that on the chart. So these are all the spider sectors, and we can see this is 1 year performance. Even though all these sectors are part of the S&P 500, and if you buy all of them equally, you will get the same performance of the S&P 500. But we can see clearly that they are not all the same. For example, here the XLK is 31% performing this year, while the XLU is minus 12.8%. So our strategy revolves around 3 months. So every 3 months, we check the performance of these sectors. So for example, if we are doing this strategy today, the past performance of the last 3 months, XLE is number 1. It made 14%. XLC 2.9, XLF 2.1, XLV minus 1.3, and the fifth one is XLB, which is minus 2%. But even minus 2% beats minus 2.4%. So that's it. The strategy is extremely simple. Every month, we check the performance of the past 3 months of those 11 sectors. We pick the top 5. We invest 20% in each, and we hold until the end of the month. And then we repeat this again. Now, this type of strategy, rotational strategies, cannot be tested in any platform. In fact, most retail platforms, they cannot test this type of strategy. But thankfully, we have a free tool that we can do the testing with. So this is the tool we are using. It's called Portfolio Visualizer. You can use it for free to test this strategy. So here I added the 11 sectors that we are going to test. These are 11 sectors using the Vanguard ETFs. You can see we are using the 3 months look back period to see which one is performing the best. And then we will invest in the top 5 assets. The condition we have is the sector has to be above its 6-month moving average. We will trade at end of the month, and we will compare with the SPY. So let's run the test. And here we have the 3 portfolios. So at the bottom here, this is the S&P 500 sector. So since 2006, this is the data I have here, until September 2023, the S&P 500 was compounding at 9.3% with a maximum drawdown of 50% and a worse year performance of 36.8%. If we buy all the sectors equally, that is the equal weight portfolio, we can see we perform slightly worse in terms of money, slightly better in terms of drawdown. But this is our portfolio. We are making slightly more money, 9.9%. But the amazing part is this. The maximum drawdown is about 20%. So instead of 50, we're about 20. The worst year is 16.29 instead of 36. So even though we are slightly ahead in terms of money, but this is huge because we are less than half the drawdown. That means we enhance our drawdown by more than 100%. And this is easily shown here. You can see our blue line, which is our portfolio, and this is the equal and the SPY alone. You can see in 2008 crash how we are capped at around 20%, and this is the COVID crisis. We are capped at around 10%. And you can see the model selection. We are basically investing in the top 5 sectors by investing 20% of our capital in each sector. And you can see this sometimes in cash because the sector is below a 6-month moving average. So strategies like these makes a lot of sense than buy and hold. Also, it makes a lot of sense for people who don't have time to trade. Also, it makes a lot of sense for people who are trading, but they want to also diversify in other buckets. So if you are a student, if you are working full-time, if you are trading but have extra money to invest, you can use those type of strategies because they are very easy to manage. It takes like 15 minutes, 20 minutes a month to implement such a strategy. So this is our strategy, making about 10% compound annual growth rate with about 20% drawdown. We can further enhance this strategy by not allocating the money equally to each sector, but by allocating the money based on volatility. And this is the result that we will get. So now we enhance our return to 11.29 and we reduce our drawdown to 18%. Also, our worst year goes down to minus 137. Now, this is huge if you are calculating your performance every year, but of course, you still have this drawdown. And you can see the difference now in the model selection. You can see now, even though we have the 5 sectors, for example, in September, we are only invested in this sector. And in August, we are investing 35.7, while the other sector is 64.29. So you can see we are not holding 5 blindly, 20% each, but we are allocating based on the volatility of that sector. And that's why we are extracting more profit and reducing our drawdown. This can be further enhanced using different methodologies, and I use those methodologies to build different portfolios. So here in the VIP Plus community where I have all these portfolios, these are all portfolios using some version of this rotational momentum strategy. So for example, here I have the core and US sector rotation. And for example, I introduced this portfolio last month and it trades all these sectors. So the Vanguard, US sectors, the global sectors, and the small cap sectors. And then it uses some version of rotational strategy to invest in. And if we look at the PDF file that comes with this portfolio, you can see that we are making 15.38% compound annual growth rate with 15.9% drawdown. So as you can see, we enhance our return and we enhance our drawdown by using different flavor of this rotational strategy. Algo trading is not for everyone, but investing, it is for everyone. And with strategies like these, you have no excuse not to invest in the financial markets. But you need to do it with a system. The system will take all the emotions away, will take all the research, all the news, all the spikes away, and it becomes extremely easy to invest your money. Those rotational strategies, momentum systems, have been researched with more than 400 white papers already, invested with billions of dollars. So they are very robust. They've been working for the last 100 years, and there is no reason not to expect them to keep working for the next 100 years. To learn more strategies like these, watch this video, and I will see you there.